Okay, so in the previous video we had been looking at the loan-to-value box plot for African Americans relative to the rest of the population. The box plot is quite useful in that it allows us to look at the range of values, consider the mean, the first quartile, the third quartile, the interquartile range, and then the outliers. And when we examine the median LVR on loans that were accepted, keep in mind in the structure here that we've developed in the graph, on the left hand side of each of the respective credit scores that we had set out using the facet wrap syntax from ggplot2 package. On the left hand side here we have mortgage approved, so the no means mortgage approved in each instance. Okay, so now interestingly, when we split apart the African American population, yes, and otherwise, using here just a simple syntax of color, right? We put color equal to black. That syntax allows us to make to bifurcate the different populations. What we notice for African Americans, interestingly, LVR is a little bit higher. So the median value, not in every instance, okay, that's also important to see, but not in every instance, but the LVR, the median LVR, is a little bit higher. Not quite 1. In the medium LVR is never quite 1, right? But for those cases where the mortgage is accepted, if we examine the LVR compared to African Americans and other population, then what we observe is that mortgages were accepted, mortgage applicants were accepted from African Americans with typically higher LVR. That's true for the credit score 1, credit score 2, credit score 3, not so evident here, credit score 4, evident in credit score 5, evident in credit score 6. So it's to some degree this is interesting because it would suggest that American banks, commercial banks, weren't engaging in a form of credit rationing. In fact, they're applying in what we might refer to as a more liberal type lending policy towards African Americans, at least in this instance. Now, it may also reflect a sort of market reality. If we assume that African Americans have lower levels of wealth and lower levels of inherited wealth, banks may, just as a practical matter, decide to lend to African Americans who come with less equity to when they're purchasing, seeking to purchase and borrow money to purchase a home. There may be just a reality, an economic reality, that African Americans have less accumulated wealth, and imposing loan-to-value ratios 75-80% presupposes that individual loan applicants are bringing an independent amount of wealth. There may not be that level of accumulated savings, and there may not be gifts that can be imparted from other family members. Also, banks may not necessarily, in every instance, may not be in their interest to discriminate against African Americans, because these are also customers, and you want to profit maximize. If you're not lending, you're not maximizing profits. So banks who develop a reputation or cut off one segment of the population may in fact be missing out on profitable opportunities. And so purely from a profit maximizing self-interested perspective, discriminating against a minority in terms of imposing harsher conditions when lending, it may not make economic sense. We also know that the predatory lending activity that was engaged in, particularly in subprime, that occurred later in the early 2000s up to 2006 when the financial crisis kicked off, and then ultimately the subprime crisis manifested itself. Part of the genesis of that was, okay, there was very relaxed interest rates during the period from 2001, probably from 9/11, or even dating before, from the dot-com bust up to 2004, 2005. Interest rates had remained very, very low. But we also know that there was predatory lending, and certain segments of the population were targeted at very liberal type lending, and that produced high profits, at least in the short term, for financial institutions, but destructive for right across the population, but particularly for ethnic groups. Okay, so again, keeping in mind this was a data set that came from 1990, set up based on information collected in 1990 HMDA data, and then data that was supplemented by the Federal Reserve of Boston in the Manel et al. 1996 paper. So we can also in Tidyverse create pivot tables. These are good because they basically, if we understand pivot tables from Excel, then we can also implement these in Tidyverse, and generally we have more flexibility because we're not conforming to a particular template. We can create our own templates, and that's one of the advantages of using Tidyverse. So if we create an object, a pivot table, we'll call it pivot 1, and we take again the same data set all and group by deny, and then summarize. So we break the population or the sample into those who were approved mortgages and those who were denied mortgages, and then we summarize by the median LVR, and then count each segment and arrange in terms of deny. So let's just run that and then view. And very simply, again, the code we can see is down here, and we compare against what we have here. So typically, and again, interestingly, it's when banks approved, deny, no means approved, the median LVR was 77% of the loan to value. So we had a ratio for the loan to value of 77% for those who were approved. And for those who were denied a mortgage, those applicants came with LVRs typically, median LVR typically, that was a little bit higher, 82%. So generally the higher LVR counted against you, although when we look here at African Americans, they seemed to enjoy, want of a better term, they seem to be able to avail of loans with higher LVR. The count here, the bulk of people who applied for mortgages got their mortgage, about 10% or a little bit higher than 10% were rejected. Okay, so we can develop that a little bit. We could look at the LVR again, but in this new pivot table that we create, we change just very slightly the syntax. We now want to group not only by deny, we also want to, so those who were denied a mortgage, got the mortgage or not. We now want to look at those who got the mortgage or not, and those who were denied mortgage insurance or not. Okay, and we arrange in this order, but otherwise the code is exactly the same. So let's just run that script and view, and keep in mind we have the script here now down in the console, And when we look at those who were denied, who were successful in getting their mortgage and who were successful in getting mortgage insurance, the median LVR here was 77%, and we can see that 2,091 of the total group. So if we look at the total group here, there was 2,380 applicants, but the vast bulk of applicants were successful in getting their mortgage approved and getting mortgage insurance. LVR here was typically quite low, so there seems to be strong suggestion, some relationship here. Lower LVR tended to be associated with higher levels or more success in terms of getting mortgage approved and mortgage insurance. Now, when we look at the next category, again, this is a pivot table, and we have included in here another category, and we have in pivot table 1 we had 2 categories. By including DMI in the pivot table, now we have 4. So here we're considering where some individuals were actually successful in getting the mortgage but not successful in getting mortgage insurance. They had higher median LVR and looks quite high, but the numbers here are very small, just 4. So something else perhaps was going on. Maybe they had some liquid assets, or maybe alternative income or something that banks felt confident that they could lend individuals in this category, even though they don't have mortgage insurance, and LVR looks a little bit elevated. The third grouping here is those who weren't successful in getting a mortgage but were successful in getting mortgage insurance approved. Again, LVR tends to be higher. The group is not trivial, it's 241. So there was a group here who did get mortgage insurance but did not get their mortgage approved. So they were denied. And again, we associate that with a higher LVR. And then finally we have this smaller group who were rejected both for their mortgage, rejected for mortgage insurance, and we can see here LVR typically in this instance quite high. And again, this would suggest that the banks are somewhat prudential generally when lending. Higher LVR denotes higher levels of risk, and banks are cautious and not in every instance prepared to take on that risk. Again, when we looked at that's what makes this particular graph a little bit interesting. When we looked at the different populations, we noted that for African Americans, typically the median value for LVR for those who are actually successful in obtaining mortgages tend to be higher than the other segment of the population. Okay, so let's have a look at pivots. Okay, that's pivot 1 and pivot 2. So we have 2 pivot tables there. We could just run a C tree here very briefly, and we've done this. We'll do this in more detail later. But the C tree allows us maybe to aggregate a lot of the insights from the exploratory data analysis. We'll come back to that in a moment, but the C tree is something that we will address and look at when we consider logistic regression and modeling and random forest. Last thing here, if we include in more categories in terms of group by, we can see we expand our pivot table, and if we view that, let's run that, you can see we've opened up a bigger range of options. I won't go through it here. It's something that maybe you can take a look at in your own time, but it does illustrate some of the capability of pivot tabling in Tidyverse.